Welcome back to my channel, Miss Personal Finance. In today's video, we'll be going over a topic from our home ownership series. In the last video, we went over the foundation, the steps you would need to take or have in order if you chose to finance your home, like take out a mortgage. And we went over the credit profile, steady income, and money in the bank. So in today's video, we are going to deep dive into the first topic, which is your credit profile. And I'll be going over or discussing these topics as it pertains to the home buying process. So let's go ahead and get started. Now, as you know, your credit report is essentially like a report card for adults. It lets lenders and creditors know how you are with your money, how you repay your loans, how responsible or irresponsible you are with credit. It kind of shows a history of every single credit transaction that you've had. So if you had your first credit card at 18, that would still show up on your credit report, although the account may be closed, paid in full, or still open and inactive, or open and actively being used. It will still report or show on your credit report. So even if you close an account, just keep in mind it'll still be there as that running history on your credit report. Now, as it pertains to a loan, a home loan, now with the credit reports or the credit agencies, there are different types, but probably the most familiar is going to be your FICO score. So that is the score that lenders look at, or one of the credit scores that lenders look at to, again, see your credit history and how you've used credit in the past before they take out or lend you a large amount for this new line of credit, which would be for your home loan or your mortgage. Now, your credit report is made up of different parts. Everyone says they don't know the exact formula that FICO or other credit agencies use, but essentially it breaks down to about, let's write it down here. Now, this number can range from anywhere to from the 300s to the 800s, like 850. And it's pretty much like a grade for your credit history, what you've done in the past and what you're currently doing with the credit that you have. And it can range from excellent, very good, good, fair, or poor. And it's made up of several parts, one being the payment history. Now, with the payment history, again, they said they don't know the exact formula or algorithm, but what past data has shown is that your payment history takes up or makes up about 35% of your credit score, the actual score. This is important because this is the largest percentage of all of the sections. Now, your payment history is exactly that. If you have a late payment, it will report. It will decrease your credit score drastically. You'll see a huge dip. The creditors will report to the credit bureau, whether it was 30 days late, 60 days late, 90 days late, and all of those put you in the delinquent category. Payment history is among the top, like the number one factor in determining your credit score. It's essentially a contract between yourself and the creditor that they're giving you this money and you're promising to pay it back at a certain time for a certain amount. It's important to at least make the minimum payment. So if you are unable to make anything over, above, or beyond, definitely try to make at least the minimum payment amount to any credit cards or any outstanding loans, so that one, it doesn't hit your credit report and decrease your credit score, and two, so that you can continue to show that payment history that is a positive payment history. Okay, and the next largest section that makes up your credit score is going to be amount owed. Now, the amount owed to any creditor, meaning like a credit card, a personal loan, auto loan, even your mortgage, this amount owed is probably the second largest factor. It's at 30% approximately of your credit score. And a lot of people remember this 30% amount because when you have a credit card, they say try to not max it out and at least have it at 30% or below. Ideally, you actually would want your credit card to be at a zero balance at the end of the month, but you can see more favorable scores with up to 30%. Over 30%, it may start to negatively impact your credit score. Now, going back to the credit card payments, a lot of mistakes that I've seen borrowers make with their credit card usage is paying the amount in full, but not prior to the statement date. Now, the payment date and the statement date are different, and this is how the credit card companies kind of trip people up and ensure that they are charged interest. So the payment date is the date that they want at least the minimum payment, but preferably the entire balance paid. Now, a couple of days later, that could be 1 to 2, even 5, 6 days later, they will have the statement date. This is where you get your statement that's generated, usually electronically. I mean, if you still have it via mail, it's probably mailed out to you, but that is the date that the creditors report to the credit bureaus. So this is the date by which you want your credit card balance to reflect a zero. So what happens is borrowers will pay the amount in full on, let's say, a Monday, and they will continue to use the card Tuesday, Wednesday, Thursday, and it doesn't report until Friday. So that balance that you incurred throughout the week is now posted as the statement balance. So now you get a statement with an amount and interest charged. So always remember, you're paying your minimum payment by the payment date, but your balance in full by the statement date. Once the statement is generated, in this case, in this example on Friday, on Saturday, when you start using your card again, it will start off at a zero balance instead of the balance from the previous week. Hopefully that makes sense. If it doesn't, just leave a comment and I'll be happy to clarify that. So amount owed is really important. You want to keep it as low as possible from the beginning balance, preferably 30% or less on all of your credit cards, personal loans, etc. Now, the third thing, or the third topic or section that your credit score is comprised of, is going to be your length of history. Now, this one is a tough one because in order to get credit, have credit, good credit, you have to get credit. And in the beginning, it's very hard to for creditors to lend you money because they don't know your history. They don't know what your habits are, what your financial record is. So length of history, the earlier the better. So if you can responsibly get any type of credit at a younger age and show that responsible usage throughout, that starts the clock ticking on your length of history, and the longer the better. So on your credit report, you may see something like the average age of your accounts. So the longer your length of history, credit history, the better. Now this one's about 15%, makes up about 15% of your credit score. And it's also important. So this also lets us know that sometimes it's not a quick fix to improving or getting a higher credit score, because if the issue is little to no credit, that length of history is literally going to take time. So over time, you'll start to gradually earn the points related to this section as you increase your length of credit history. The other one is, the next one is going to be your credit mix. And that's about 10% of your overall credit score. Now, what is a credit mix? The credit mix is the type of debt or type of credit that you take out. So there's a difference between installment loans and revolving credit. So for installment loans, it's equal payments usually over a set period of time, and you're paying the same payment, about the same payment every month, and at the end of that set time, that balance will be zero. So you find installment loans in things like with the interest already built in with things like a car loan. So if you take out a $30,000 car loan, you know in about 3 years, if you just make your monthly payments on time, you will have a zero balance at the end of that 3 years. Now, this differs from revolving debt or revolving credit. And this is your credit cards where they give you a set amount, you use it, you pay it back, you get more. Or you're able to reuse that same credit over and over. So this is for credit cards, this is for lines of credit, and it just keeps on revolving. They just are looking at how you use that constant flow of credit. So your credit mix is important. You'll see installment loans, home loans, credit card or revolving loans. So those are the main types. You'll see car loans, and some people judge them differently. Like they look at your car loan history to see if you've financed any vehicles in the past and how you've dealt with those loans. Home loans, the same thing. So you want to make sure that you have a good credit mix. I remember when I first started getting credit cards, I would get all these department credit cards, and they're only good for one department store. So it doesn't really give a good gauge of how well you pay your revolving credit, because you're not always going to that same department store regularly or weekly. Whereas if you had a standard credit card that you can be used anywhere, like a Visa, MasterCard, American Express, they can see, hey, you've shopped, you've used it at various locations regularly throughout the month, and you're paying it back on time. So that shows that you have a good credit history. So that is important. Now, lastly, I'm sure you hear about this one as well, and that's new credit. So when you hear you have a credit inquiry or hard pulls, that's about 10%, makes up about 10% of your credit score. And new credit's really important because it's an indicator to lenders what you're doing or what your intentions are with credit at that point in time. So for example, if you are searching for a car loan, most likely that car dealership will pull your credit and search a couple of lenders to see who can give you the best rate or the best deal. Same thing for the home buying process. You always want to shop around. So if you're going to choose a lender and start the home buying process, you want to get quotes or estimates from about 2 to 3 lenders to see who can give you the best overall value for your money. So that means when you pull your credit, they may see different companies inquiring, that's why they call it a credit inquiry, about your credit history to see if you would be a good candidate to receive that new line of credit. Now, what new credit or credit pulls also show the creditor is that if you are in financial trouble, for example, they'll see that you're opening a flurry of credit cards, and they may stop and not want to lend out because they're like, hey, there may be something going on here, because they've applied for, let's say, 3 credit cards in the last 3 months. So they may be short on cash flow, cash strapped, and this is probably not a good candidate or a good consumer for us to lend additional credit out to. So be careful. You want to limit the new credit to 0 to 1 a year. You really, people with good credit usually don't take out new credit often. You'll see years in between the time from one credit card or any other new credit card or line of credit. And that's important because it does make up about 10% of your credit score. So as you can see, each section, even if you use this as an estimate, it adds up to, 100% of your credit score. So it's made up of these 5 sections, more or less. So if you take anything away from this portion, is that your payment history is extremely important, and you want to make at least your minimum payments on a monthly basis to keep up with your credit history and show the lenders that you are financially responsible and that you can take on new or additional debt. Now, with all this said and done, this is actually not the most important part about credit scores as it pertains to your home loan or your mortgage. The most important thing about your credit score is what it determines for your home mortgage, and that is your interest rate. Your interest rate is essentially the cost of borrowing money, and it is inversely related to your credit score. That means the higher your credit score, the lower your interest rate, which is a good thing. The lower your credit score, the higher your interest rate, which is a bad thing because that means you're paying more money for the same amount of money being lent out. So to be perfectly honest, there are some home loan programs where you can get a home loan with a credit score as low as 580. Now, the caveat to that is you will be paying a ton in interest. Your interest rate will be so high, higher than the average interest rate, because they're saying this is a risky borrower. Based off their credit score or based off of their credit history, it's showing that they're not good at managing their money. They're not good at their finances. They're not good at managing credit. So we will lend them this money, but we're going to charge them a lot because the risk of default, the risk of them not paying or discontinuing their payments is high. So in order to counteract that risk, we're going to charge them a lot in interest to make up for that difference. Whereas if you have a credit score that's in the 720s, the 740s, you're getting the best rate, meaning you're getting the lowest rate, you're paying the least amount of time over, you're paying the least amount of money over time on that loan or that credit card. So it's super important for you to, when you're going into the home buying process, to take a good look at your credit score, your credit history, and kind of see anything that may come up as derogatory or negative on your credit report and work to fix that prior to applying for a loan. Because when you apply for that loan, that's actually going to hit as a new credit and may slightly decrease your credit score for the time being, because as you can see, it only takes about 10%, makes up about 10% of your overall score. Now, your payment history, if you have any late payments within the last 12 months, it may negatively impact your credit score where you won't be able to, or you may not be able to take out a home loan at that time. So you want to make sure that you're focusing on all 5 sections of your credit score, because it greatly impacts your interest rate, what you'll be paying on that mortgage. And right now, interest rates are already historically high, so you don't want anything else making that any higher. Also, some lenders charge extra just based off of your credit score, especially lower ones, again, to counteract that risk of you defaulting or not paying your mortgage payments on time or at all. Now, when the lender is going through your credit report, they're looking at all these things, of course. They're looking at the types of loans that you have, but they're also looking at your monthly payment. Your monthly payment is going to also impact your loan amount, or the amount that you can put towards your mortgage. So if you have a ton of debt and you're paying thousands of dollars a month just in minimum payments, it may be hard for you to also tack on a mortgage loan on top of that. Now, if you have monthly payments, they're low, they're just a couple of outstanding items, it'll be easier to add on a mortgage without making it financially burdensome for you as the borrower. So they're going to look at that. Now, any student loans or medical debt, lenders may just use a small percentage. They're only going to look at the monthly payment. If there's not a monthly payment being reported because it's in forbearance or some kind of break in payment, then they'll just calculate it at a lower percentage, usually about, between 1 to 3, maybe even 5% of the total amount. And for those who owe in excess of $100,000, that could be a good break, because if you have to make payments, standard payments on $100,000, that can be a lot. So your lenders are flexible with that. And with medical debt, usually if it's a low amount, they may have you paid in full, but if it's a higher amount, they may exclude it altogether, or again, just count it as a smaller percentage of that monthly payment. Now, overall, when you're purchasing a home or taking out a mortgage, you want to ensure that you can afford other basic necessities outside of your mortgage. So your lender is going to look at your entire debt profile. They're going to look at your entire credit score, your credit history, and look at your debt to income. So how much debt you have reported on your credit report versus the income that you're bringing in. So the higher that number, the worse. That's saying that all the money that you're bringing in, most of it is going towards debt. So they want to see a lower debt to income ratio, and they just refer to that as DTI. So debt to income. Debt to income. So credit score, you want up. We talked about interest rate. Interest rate, you want down. You want as low as possible. And debt to income, the debt. Once you hear debt, you just know you want that low as well. So that's how it kind of works to figure out what rate you're going to get, what your total monthly payments are going to look like, what type of debt they count against you or not. So all of this comprises or makes up what your interest rate will be and the total amount you'll pay on that mortgage. So to prevent having a higher monthly mortgage payment, you want to focus on your credit score prior to starting the home buying process and make sure that you are in the 700s ideally. Again, you can get a home loan in the high fives, 600 range. It's definitely possible. Just know for a fact you will be paying a higher amount, a higher interest rate than a consumer or a borrower who has a higher credit score, like in the 800s. I think that's about it. When it comes to the credit score and how it pertains to the home buying process. Okay, and that's all for this video. Hopefully that was helpful. We did a deep dive into the credit score, and we'll go over the other topics in later videos. So if you have any questions or would like to get more information, don't forget to like or just put a comment below and subscribe. And remember, whatever you put your energy and focus toward, you're bound to see progress.